Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
And today, well, we are finally talking about the one the market has been holding its breath for.
We are.
The FCA has officially confirmed Policy Statement PS26. The waiting game is over. The rules are finalized.
And we have a date.
We have a hard go-live date, 15 July 2026.
It is a massive moment. I mean, we've been talking about the Wild West of Buy Now, Pay Later for years. Well, the shared has officially arrived. The perimeter has expanded. Deferred Payment Credit, or DPC as we now have to call it,
Yes.
is officially inside the club.
And joining the club sounds nice, but let's be real about what that membership costs, shall we?
Well, exactly.
We're talking full FCA authorization, the full weight of the consumer duty, strict CONC rules, and crucially, for the risk teams listening,
Yes.
access to the Financial Ombudsman Service.
That last one is the game changer. But you're right. I mean, looking at the sources, this is absolutely not a light touch regime.
Not at all.
If you were hoping for a watered-down version of consumer credit regulation, our PS261 is a wake-up call. We are seeing new expectations for affordability checks, very specific requirements for arrears management, forbearance.
It's a heavy lift.
It's a huge lift. It feels like the era of move fast and break things is well and truly over for this sector.
Completely. And there's a survival gate buried in the fine print that I think a lot of people might miss.
The TPR.
The temporary permissions regime. The timeline is incredibly tight. You have a 6-week notification window opening in mid-2026.
Just 6 weeks.
If you miss that, you are out. Game over.
We are definitely going to spend some real time on that later because those dates are tricky.
They are. But looking at the early reactions from the legal heavyweights Linklater, Skadden, TLT, the vibe is interesting. It's broadly supportive, but there are massive caveats.
Oh, huge caveats. All about the cost and the sheer operational complexity of getting this done in time.
Well, that leads us to the big theme for this deep dive, doesn't it?
It does. If you think about the last 5 years, Buy Now, Pay Later has been selling one thing and one thing only. Frictionless finance.
One click.
One click, no interest, the item ships. It was designed to bypass the friction of traditional credit.
And now,
what PS261 tells us is that the FCA is effectively pricing the friction back in.
pricing the friction back in. That is a great way to put it.
It's the reality. And for the banking professionals listening, I want to be clear. This isn't just about adding a new product code in the ledger.
No.
This impacts your funding partners, your merchant acquiring relationships, your credit risk controls, and your exposure to FOS complaints.
It's a total governance overhaul.
And it is all anchored, inevitably, in the consumer duty.
So let's unpack this properly. Let's start with the definition itself, because words matter here.
Right.
BNPL finally joins the club.
Or, as we should probably start calling it,
DPC joins the club.
right. The terminology shift is important. According to the FCA's policy statement, deferred payment credit is the new legal wrapper.
And the rules go live on 15 July 2026.
Correct. And the definition is very specific. We are talking about interest-free credit, repayable in 12 or fewer installments within 12 months or less.
Why did they settle on that specific boundary? 12 months, 12 installments. It feels a little arbitrary, doesn't it?
Well, I think it's about catching the modern BNPL model without, accidentally regulating invoicing or other standard business practices. But as Skadden and Linklaters point out, the key is that third-party lenders offering this specific type of credit must now be authorized.
So the old exemption is gone.
For third-party providers, that exemption Article 60F2 is gone.
So if I'm a fintech lender, I can't just claim, oh, it's short-term and ignore the handbook anymore.
Exactly. The full handbook applies. We are talking about the consumer duty, key chapters of CONC, specifically regarding conduct of business, and, of course, complaints handling.
I want to pause on the consumer duty aspect, because we often treat authorization and consumer duty as two separate boxes to tick. But here, they seem completely fused together.
They are. You have to remember, BNPL products were designed to be seamless. They were designed to encourage impulse purchasing at the checkout.
Of course.
The consumer duty requires you to prove that the product delivers good outcomes and that the consumer actually understands what they are signing up for.
Which is hard to prove when the customer spends exactly 3 seconds clicking Pay in 3 while buying a pair of trainers on a bus.
Precisely. You can't just slap a regulated by the FCA logo on the checkout page and call it a day.
Yeah.
You have to retrofit governance into a user experience that was built to avoid governance. It challenges the fundamental design of that checkout flow.
That leads me to a practical point for the teams listening. I've noticed the legal sources are very specific about the naming convention. You mentioned DPC earlier. Is that just legal jargon, or does it matter for the business side?
Oh, it really matters for the business side. Banks really need to stop saying BNPL in their internal policy documents.
Why?
Because the FCA uses DPC for a reason. BNPL, buy now, pay later, technically refers to existing regulated products that are already in the handbook, usually interest-bearing ones.
Ah, okay. So if I'm ahead of compliance running a search on my policy library for BNPL, I might be pulling up the wrong rules.
You might be auditing against a rule set from 2010 rather than PS261. The distinction creates the legal perimeter. If you don't get the taxonomy right, you'll be applying the wrong controls to the wrong products.
That is a crucial distinction. So here's our first do this next week for the strategy and commercial teams listening. Audit your product catalog.
Yes.
You need to distinguish between what is legally DPC and what falls under the merchant-owned credit exemption.
Which remains unregulated.
Exactly. We will touch on that later.
Correct. Know what you are holding. Don't assume everything that looks like pay later is DPC.
Okay, let's move on to the hidden work. Because everyone talks about the license, getting the permission is the sexy part, I suppose.
I suppose, yeah.
But the real pain is in the back office. We're talking affordability, arrears, and what I call the MI grind.
This is where the rubber meets the road. Citing Skadden and the FCA's own feedback in the policy statement, existing creditworthiness rules, specifically CONC 5.2a, will apply to all agreements.
All of them. Even the really small ones. I thought there was talk of a light touch for small baskets.
That was the hope. But the reality is stricter. The definition of a small agreement is being amended to ensure that even sub-£50 purchases require checks.
So the free pass is over.
The free pass for microtransactions is effectively over, yes.
Walk me through the mechanics of that. If I'm buying a 40-pound t-shirt and the lender has to do a creditworthiness check, doesn't that just kill the conversion rate?
It threatens it, certainly. The rules say you have to perform a proportionate check. Now, for a 40-pound item, you probably aren't demanding 3 months of bank statements.
I don't know.
But you do need to verify income and expenditure in some way. Skadden suggests a lot of firms will turn to AI and open banking to automate this.
Of course.
Because you physically can't have a human underwriter reviewing a 40-pound loan.
But automation brings its own headaches.
Huge ones. And here is the trap. If you automate checks using AI, you must test and validate those models. If your AI says yes when it should have said no, and that customer defaults and goes to the financial ombudsman, your liability increases. You have to prove the machine made a compliant decision.
That seems like a massive data challenge.
Yeah.
You're bringing in open banking data, crunching it in milliseconds, and making a decision that is legally defensible 2 years later in front of an ombudsman.
Exactly. And Linklaters highlights another layer here regarding what happens after the purchase. You can't just send a text saying, payment failed, try again.
Because now you're a regulated lender.
Yes. The arrears management rules are strict. Firms must signpost free debt advice and offer forbearance. If a customer misses a payment, you have to treat them with the same care as a mortgage customer in arrears.
You can't just have a bot retry the card 5 times a day.
No, that's over.
This brings us to the data aspect. You mentioned the MI grind. What does the FCA want to see?
They want everything. Firms must report transaction-level product sales data, or PSD. The FCA wants line of sight on every single loan.
Transaction level. So millions of lines of data.
Millions. And for many fintechs and even some legacy banks, their data architecture just isn't built to pipe that level of granularity directly to the regulator on a recurring basis.
It feels like the friction we talked about is actually a feature here, not a bug.
Exactly. That is my hot take on this segment. The friction is the point. The days of one-click debt without a data footprint are over.
Right.
The operational cost isn't just the credit check fee, it's the back-office engineering required to build those PSD returns. If your data architecture isn't ready for that, you are in trouble.
So for the risk and compliance folks, do this next week. Review your credit risk models, especially for high-frequency, low-value lending. Ensure you can process proportionate checks without killing your checkout conversion, but also without failing the regulatory test.
It's a delicate balance. Too much friction, you lose the sale. Too little, you breach the rules.
Okay, let's move to our third area. We mentioned a survival gate in the intro. Let's talk about the temporary permissions regime, or TPR.
The quiet cliff edge.
Yes, because reading the timeline of the TLT commentary, It really sounds like one.
It is. The mechanics are laid out in the UK government legislation. Because this is a new regime, they need a way to move existing firms into the rules without shutting the market down. So they created the TPR.
So how does the window work?
The notification window opens on 15 May 2026 and closes on 1 July 2026.
So that is a 6-week window. That is.
It is. But here is the kicker that I think some people have missed. To be eligible to even apply for the TPR, a firm must have been active in DPC lending by 15 July 2025.
Wait, back up. July 2025, that's next year.
Next year.
So if a fintech startup decides to launch a cool new DPC product in, say, Christmas 2025, they can't get into the temporary permissions regime.
Correct. They would have to wait for full authorization, which takes months, maybe a year, before they could lend a single penny.
So it's a binary risk.
It's a binary risk.
Huh.
If you miss the window or if you weren't active by the cutoff date, you cannot lend on regulation day in July 2026.
And what happens if you do?
Entering new agreements without permission becomes a criminal offense.
Crikey, that is huge. And I want to connect this to third-party risk, because a lot of our listeners work in big banks that provide funding lines to these fintechs.
Absolutely. If you are a bank providing a warehouse facility to a BNPL lender, you need to be wide awake to this.
Right.
You need to ensure they are eligible for the TPR. If they miss that notification window or if they started trading too late, your lending facility effectively goes to zero volume overnight.
Because they can't originate.
They can't originate.
It really is a quiet cliff edge. There is no grace period mentioned in these sources.
None. A 6-week notification window in mid-2026 is a dangerously small target for disorganized firms.
So, compliance teams, do this next week. Front-load your planning. Verify that any DPC partners you fund have evidence of activity prior to July 2025 to ensure they are actually eligible. Don't take their word for it. No. Check the dates.
Trust, but verify.
Before we get into the market reaction and the sting of the FOS fees, just a quick reminder. If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
Right, let's look at the reaction. We're calling this segment Applause with Teeth.
It's a great phrase. Because on the surface, everyone seems happy. The press releases are all very positive. What's actually happened?
Well, the consumer voices are loud and clear. Citizens' Advice calls it overdue but welcome.
I can imagine.
They've been seeing the harm on the ground, people stacking up multiple BNPL debts for essentials like groceries.
Yeah.
Money-saving expert is also supportive, but he's warning consumers to be careful because these protections don't actually start until 2026. So there is a gap.
And on the legal side?
Linklaters, Hogan Lovells, Skadden, they are all supportive of the clarity. Lawyers like certainty, but they are warning their clients about the cost.
Of course.
And Retail Banker International reports that major players like ClearPay see this as a milestone. They want the legitimacy. But they also note that smaller players face a massive squeeze.
Let's talk about that squeeze.
Oh, no.
We need to join the dots between the applause and the teeth of the Financial Ombudsman Service fee.
This is the sting in the tail. The Financial Ombudsman Service, the FOS, case fee is around £650 for the lender. Now, imagine a dispute over a £40 pair of jeans.
The fee is more than 15 times the value of the loan.
Exactly. And even if the lender wins the case, they still often have to pay the case fee.
Just one dispute.
A single dispute destroys the margin of dozens, maybe hundreds of successful loans.
Which leads to a terrifying hot take.
Yeah.
Are we looking at a settlement culture?
I think it's inevitable. Rational lenders will just pay off frivolous complaints to avoid this £650 fee. A customer says, I didn't understand the terms. And the lender says, fine, here is your £40 back, just don't go to the ombudsman.
But doesn't that incentivize fraud, or at least incentivize chancing it?
It changes the economics of the product entirely. If you are a bank backing these loans, you need to factor that leakage into your P&L. The cost of doing business just went up significantly.
It's a fundamental shift.
A fundamental shift in the unit economics of small-ticket lending.
So commercial teams, do this next week. Model the P&L impact of FOS fees on your low-value loan book.
Please do.
If your dispute rate goes up even by a fraction of a percent, what does that £650 fee do to your profitability?
It could wipe it out completely. You might find that loans under, say, £50 are simply not viable anymore.
Okay, let's move to our final segment. Our contrarian take. Because we've talked about the rules, but what about the unintended consequences?
Well, there is a tension here between the long runway regulation days, July 2026, and the harm that citizens' advice says is happening right now. But the contrarian angle comes from the loophole we mentioned earlier.
It's merchant loophole.
Yes, the government legislation specifically exempts merchant-owned credit. So, if a big department store or a gym offers you interest-free credit from their own balance sheet, not using a third party like Klarna or PayPal,
Okay.
that remains unregulated.
Exactly.
So Baker McKenzie and Regulation Tomorrow are suggesting firms shouldn't wait to implement consumer booty standards, but if I'm a retailer, isn't there an incentive to just do it myself and avoid the regulation entirely?
That is the risk. It creates a two-tier market. You might see risky lending shift from the regulated third-party providers to unregulated store cards or merchant schemes.
That feels like a reputational minefield for banks.
It is. If you are a bank providing the back-end funding for a retailer who is running their own unregulated scheme, are you comfortable with that?
Just because it is legal doesn't mean it fits your risk appetite under the consumer duty.
Now, what about the transition itself? If firms decide this is too hard and just exit the market abruptly before 2026?
That is a consumer duty breach in itself. Regulation Tomorrow flags this specifically. If you pull a product without warning or communicate the changes poorly, you are causing foreseeable harm.
You can't just unplug the server and walk away.
It's a bit like leaving a party, isn't it? You can't just vanish. You have to say goodbye properly, or people get upset.
And in this case, upset means regulatory intervention.
Precisely.
So what's the strategic move for next week?
Assess your white label risks. If you are backing a merchant-owned credit scheme, know that it sits outside the specific DPC regulation. But ask yourself, is that a ticking time bomb? Are you enabling a lower standard of protection?
That is a very good point. Just because you can doesn't mean you should.
Precisely. The gap between what is legal and what is good practice is where the reputational damage usually hides.
All right, let's wrap this up. We've covered a lot of ground. Let's do a quick recap. What are the 3 things banking professionals need to take away from PS261?
Okay, first, DPC is the new BNPL. It is in the perimeter, and the rules go live on 15 July 2026. Stop using the old terminology and check your legal definitions.
Second,
Affordability checks are mandatory even for purchases under £50. The free pass for microtransactions is over, and that requires a massive data capability upgrade.
right, for the product sales data reporting.
Exactly. And PPR is a binary survival gate. You have a 6-week window in mid-2026, miss it, and you are out. And crucially, check your eligibility dates. You need it to be active by July 2025.
And watch out for that merchant loophole and the impact of those FOS fees on your margin.
Especially the FOS fees. That is the silent margin killer.
So here is the question for senior leaders to chew on this week. When the friction of regulation, the credit checks, the data reporting, the £650 FOS fees, meets the razor-thin margins of a £40 purchase, is the buy now, pay later model actually sustainable for banks, or have we just regulated the profit out of it?
That is the multi-billion-pound question.
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp, stay informed, and stay compliant.